Okay, so welcome back, everyone. So this is week 12 of BUSI 2315, and this is going to be dedicated entirely to preparing you for the final exam. Because by now you've covered a lot of information across material, for example, in marketing, finance, human resources, and of course, operations. And what this video is designed to do is bring all of that together in a coherent and useful way. Rather than simply repeating definitions, today we're going to focus on how to think through the kinds of scenarios that you're going to encounter on the exam. That shift in approach from memorization to analysis is the most important thing that you should be able to take away from this session. So, why don't we get rolling? Now, before we go any further, I want to be direct about what the exam is and is not. This is not a test of your ability to recall definitions. Every question is scenario based, and all of those scenarios are built around Sarah's business, that case study that you've been working through throughout the course. What the exam tests is your ability to diagnose what's actually going wrong in a given situation and to explain the underlying reasons why, drawing from your textbook as well. So, with that said, it's not going to earn full. Say, for example, if your answer described what's happening, but not explaining why it's happening, you're not going to earn full marks. The difference between a good answer and a great one almost always comes down to that distinction. Be sure that you're not only explaining what's happening, but explaining why it's happening and possibly taking it that next step further, which is, of course, explaining what can be done as a result of it. So, really, what the exam's going to draw from is all four functional areas of the course: marketing, finance, human resources, and operations. More importantly, it's going to test whether you can recognize connections between those areas. Sarah's business doesn't have a marketing problem or finance problem in isolation. She has interconnected problems. So, for example, that are rippling across every part of her organization. One of the core skills in the exam is going to measure is your ability to identify the root cause of the problem rather than simply naming the symptom. If Sarah's losing customers, remember that's the symptom. Why she's losing them and how that connects to the decision she's made elsewhere in the business is the analysis that the exam is looking for. The concept of systems thinking, which is what you've encountered throughout the E-Myth framework, is directly relevant here. So, the exam consists of three sections, as we've talked about in class. The multiple choice section presents you with a business scenario and asks you to select the best explanation for what's occurring. You're going to have 25 questions that are multiple choice, and they're worth 1 mark each. So read the questions carefully because every option may sound plausible, but your job is to identify the explanation that most accurately reflects the underlying cause based on our discussions, based on your textbook, based on the case of Sarah the baker. Um, so, really, that's what you're looking for with the multiple choice. Now, the short answer sections require you to write analytical responses. So these answers need to be clear, well reasoned, and grounded in course concepts. The essay section is going to ask you to integrate multiple business functions into a sustained argument. You're going to need to move between ideas and demonstrate that you understand how decisions in one area produce consequences in another. The evaluation criteria emphasize depth of reasoning throughout, so surface level responses aren't going to be sufficient here. And I should note that, as I mentioned already, there will be 25 multiple choice questions worth 1 mark each. Then the short answer questions are going to be 5 of them worth 10 marks. Here's the difference, though. I'm going to give you 7 scenarios, and you choose 5 of them. So you have a choice in picking what ones are best for you. The essay is going to require you to integrate everything. There's one question worth 25 marks. However, I'm giving you two questions to choose from. So, really, you're going to have a lot of flexibility on what is best for you. So, while you're studying and preparing, think about the potential scenarios that could be asked of you and how they intertwine or dovetail between Sarah's case study and the textbook that you've just read. So let's talk a little bit about the E Myth that was developed by Michael Gerber. And it's really the most important framework in the course. Yes, you have a textbook, but the semester long case study, we'll call it, is what's going to be central to the exam. So in this book, the central argument is straightforward. Businesses fail not because their founders lack the technical skill, but because those founders continue to work in the business rather than on it. Now, Sarah's an excellent example. She is clearly skilled at what she does, but her business was built around her personally rather than around a, re, re, a replicable system. So, one that you can repeat. And of course, the processes surrounding it. So when a business depends on one person to make the decisions, deliver the service, and maintain the quality, it can't grow in a sustainable way. The E Myth framework challenges entrepreneurs to think like designers of a business rather than practitioners within one. So, as you review Sarah's situation, ask yourself at every stage how her reliance on herself rather than on systems explains the problems that she's going to encounter. So, Sarah's case isn't simply a collection of individual business problems. Each scenario that you're going to encounter is a window into a deeper mistake that reflects a pattern. Sarah has the technical ability to do the work, but she lacks the foundational business architecture to support a sustainable growth. So, as the business grew, the gaps in the architecture became more visible. And of course, as a result of that, more costly. When you read a Sarah scenario on the exam, I'm going to suggest you resist the temptation to respond only to what is immediately apparent. Ask yourself, what planning failure or structural weakness or strategic error created the conditions for this possible situation to arise? That interpretive layer is what's going to distinguish strong answers from the weak ones. Now, one of the most common errors that Sarah makes is treating short term demand as a reason to expand permanently. This is a significant strategic mistake, as it appears in multiple scenarios throughout the course. When demand spikes, it's tempting to hire more staff, lease more space, or invest in additional equipment. However, if the demand is seasonal, promotional, or otherwise temporary, we'll say, those instruments and investments become a burden the moment that the demand returns to its normal level. The core principle here is that entrepreneurs have to validate demand over time before committing to fixed costs. Fixed costs don't disappear when the business slows down, which means increased financial risk considerably. Well, now, when you see a scenario where Sarah has expanded in response to a busy period, for example, and is now struggling, the root cause is this failure to distinguish between opportunity and temporary demand. This distinction is essential. And really, it's one that many students find counterintuitive at first. A business can be profitable on paper and still face serious operational difficulties because of because of poor cash flow. Profit reflects the difference between revenue and expenses over a period of time. Cash flow reflects what's actually available in the bank at any given point. Now, if Sarah's clients are taking 60 or 90 days to pay their invoices, she may be recording revenue that she hasn't collected yet. In the meantime, she still needs to pay her suppliers, her staff, and her overhead, the lease on the bakery, maybe payments for the equipment, etc. That gap between when she earns money and when she receives it creates a liquidity problem that can really threaten the business even when sales are strong. So whenever you see Sarah struggling to meet financial obligations despite apparently healthy sales, this mismatch is almost certainly at the heart of the issue. So the systems and scalability. Now, as the business grows, the informal processes that worked in the early stages become really inadequate. When Sarah handled everything herself, she could rely on her own judgment and memory to maintain the quality and consistency. Perhaps it's with a recipe, for example. As she's hired more staff and took on more clients, those informal approaches started to break down. Systems, meaning documented, repeatable processes that don't depend on one individual, are what allow a business to scale, to get larger. They enable training, ensure consistency, and of course, make it possible for the business to operate reliably without constant supervision from the founder. In this case, it's Sarah. Now, when Sarah's services, when her service quality becomes inconsistent or her staff performance varies, the underlying cause is typically the absence of documented systems. This is a direct extension of the E-Myth argument. So, when we're talking about marketing versus operations, marketing and operations have to function in alignment. Marketing creates expectations in the minds of the customers, where operations have to be capable of meeting those expectations reliably. When a business markets itself as, say, for example, being aggressive, like when it's marketing itself and it's very aggressively doing so and acquires those new customers faster than it can serve them well, as we talked about in class, the result is ultimately dissatisfaction or poor reviews, or worse, lost business opportunities. Sarah's business demonstrates this misalignment in several scenarios. She attracts new clients through marketing efforts without first ensuring that her operational capacity is able to absorb the additional volume at the same standard of quality. So, the lesson here is that growth has to be coordinated across functions. A marketing strategy that outpaces operational readiness doesn't guarantee or generate sustainable success. It generates short-term volume, followed by, of course, the reputational damage. So that's a key piece right there. But we're going to start talking a little bit now about the human resources structure. Now, when we're in this scenario, undefined roles are one of the most common sources of inefficiency in small and growing businesses. When employees are unclear about their responsibilities, work either gets duplicated or it falls through the gaps entirely. Sarah's HR challenges are rooted in this structural ambiguity. As her team grew, she didn't put in place the role definitions or the reporting structures or the performance standards that a larger organization or operation would require. The result is reduced accountability, inconsistent service delivery, and a management burden that falls right back on Sarah herself. So, a clear HR structure is not a bureaucratic luxury. It is a practical requirement for any business that intends to grow beyond its founder. When you see Sarah dealing with the self related problems on the exam, trace those problems back to the absence of the formal HR systems. I hope this video is helping. It's dropping a lot of hints for you. Now, when we're talking about risk in financing, how a business finances its operations, and it will ultimately have a direct implication for its risk profile. Debt financing, such as a bank loan, introduces fixed repayment obligations that have to be met regardless of how that business is performing. If Sarah's revenue is unstable or it's seasonal, those fixed obligations become very difficult to manage during the slow periods. Equity financing, such as bringing in an investor, reduces the immediate financial pressure, but comes with a trade off of shared ownership and, of course, reduced control. The key principle for the exam is that the financing decisions have to be appropriate to the stage and stability of the business. Sarah taking on significant debt at a point when her revenue is unpredictable introduces a level of financial risk that is disproportionate to what her situation really is. When you consider or encounter those scenarios about Sarah's financial difficulties, consider whether a mismatch between her financing choices and her business stability is actually contributing to the problem. Now, centralization versus delegation. When a founder insists on being involved with every decision, the business can't function effectively at scale. This is the primary bottleneck problem, and it's one of the defining characteristics of the technician driven business that eMyth describes. Sarah's tendency to centralize control means that decisions slow down. Staff can't act independently, and her own time becomes the limiting factor on everything the business can accomplish. Effective delegation requires more than simply assigning tasks. It requires a documented process, defined authority, and of course, the trained staff who can be trusted to make decisions within their areas of responsibility. Leadership has to evolve as the business grows. The skills and behaviors that make a founder effective in the early stages can become a significant liability once that business reaches a certain size. Now, talking about size, customer retention versus acquisition. Acquiring new customers is expensive. As we talked about in class, it's sometimes up to 7 times as much to acquire a new customer as it is to retain an old one. And retaining the existing customers is considerably, as I've just demonstrated, more cost effective. And repeat customers tend to generate more consistent, but more importantly, more predictable revenue over time. When Sarah's client retention begins to decline, that's a signal that something in the customer experience has deteriorated. This might be related to inconsistent service quality, longer wait times, poor communication, or any number of other factors. The danger of focusing exclusively on acquisition while neglecting retention is that the business ends up on a treadmill, constantly bringing in new clients to replace the ones who've left. The exam may present some scenarios where Sarah's celebrating new client numbers while her existing client base quietly erode. That pattern is what you need to recognize and explain. Inventory and efficiency. Inventory represents the capital that's been spent but not yet converted into revenue. When Sarah holds more inventory than her sales volume warrants, she's tying up money that could otherwise be deployed for more productive uses. Excess inventory also increases storage costs and more importantly, the risk of waste, particularly if the products have a limited shelf life or if customer preferences shift. The deeper issue behind inventory problems is typically poor forecasting. If Sarah is not accurately predicting demand, she'll either overorder or carry excess stock or underorder and miss sales opportunities. Both outcomes reflect failure of planning discipline, and both have measurable impact on the financial health of the business. When we're talking about competitive awareness, one of the more common strategic errors that entrepreneurs make, particularly in the earlier stages, is to focus entirely on demand without accounting for how that demand is distributed among competitors. A large market doesn't guarantee success. If there's many, say for example, competitors already serving it, Sarah's business forecast may have overestimated her potential market share by falling to, by failing, not falling, failing to adequately account for the competitive landscape. I found that in a lot of your assignments where you were creating that business canvas, that you failed to either acknowledge the competitive landscape or what was actually going on within that area. Now, positioning means how the business differentiates itself in the minds of the customers, already directly influencing pricing power and demand. If Sarah hasn't clearly differentiated her offering, she's going to find herself competing primarily on price, which is really difficult in an unsustainable position. When you see scenarios about Sarah's growth projections failing short, competitive awareness and positioning are usually part of the explanation. As a footnote, positioning can also be titled unique selling propositions. What is it that sets you apart from your competition? And I'm going to caution, if you come across a scenario that's similar to this, remember that for Sarah's case, you can't have a unique proposition of, well, our products are better or our products have a higher quality. And the reason for that is because it's A, easier to compete against, but B, it's not sustainable if that is your primary unique selling proposition. You have to figure out what it is that truly sets you apart from your competition. Now, when we're talking about all this, there's a short answer strategy. And when we're coming to the short answer, I want to talk directly about how to approach that short answer section, because this is where a lot of students often leave marks on the table, or they often leave opportunities to get higher grades out. A strong short answer response does three things. First, it identifies the core problem clearly and precisely. Second, it explains the underlying causes using theory in the textbook or framework from the course. And then finally, it connects that problem and its causes to the broader business impact, demonstrating that you've understood the implications. What you want to avoid is describing the situation without explaining it. If a question asks if why Sarah is struggling with staff performance, and you respond by saying that her staff are not meeting expectations, you haven't answered that question. You need to explain why the situation has arisen and what it tells us about the structural strategic decisions that Sarah's made. I'm not looking for bullet case here. You should not be answering this section in bullets. It should be in full sentences. Articulate clearly what it is that you're seeing from your analysis, explaining the situation, why it's arisen, and most importantly, what it's telling us about Sarah's business. So, which kind of leads me to scalability and founder dependence about Sarah. We've covered the concept at several points in the course, but it really deserves explicit attention in the context of your exam preparation. Founder dependence is the condition in which a business can't function effectively, as I've mentioned a couple minutes ago, without the direct involvement of its creator. It is the defining problem that E-Myth defines or identifies. Um, it manifests nearly in every challenge that Sarah faces. The solution isn't simply to work harder. It's to invest in systems, documentation, and training that allow other people to perform tasks to a consistent standard without requiring constant oversight. Think about McDonald's. McDonald's CEO seldom go into any of the restaurants, but you know that every restaurant is functioning the same. You go to a McDonald's in Barrie, Orillia, Toronto, Orangeville, wherever in Ontario, the quality of the food, the way it's prepared, and more importantly, the ingredients are identical. The customer knows what to expect. This helps with scalability because it depends on the business being able to replicate really the good outcomes reliably, not on the founder being everywhere at once. It's impossible for the CEO of McDonald's to be in every restaurant at the same time. When you encounter a scenario where Sarah's overwhelmed or making errors or struggling to maintain quality as the business grows, founder dependence is almost certainly part of that explanation. Now, with the short answer questions, going back to revenue versus cash flow, we touched on this earlier in the context of cash flow management, but it's worth revisiting as a distinct concept because it appears in both the multiple choice and, who knows, possibly the short answer questions. So, revenue is recorded when a sale is made. Cash received when the customer actually pays. So the difference is if somebody orders a product, let's say, for example, you're ordering a pen from somewhere. The company ships you the pen and you have 45 days to pay that invoice. You've made the sale, which means you have the revenue, but your cash flow only gets hit with that sale once the customer pays for it. So Sarah could have technically a very strong monthly revenue figure while simultaneously being unable to pay her own suppliers on time because the cash from those sales hasn't arrived. Most situations with larger organizations is a 45-day payment period, the accounts receivable section. Profitability and liquidity are related but distinct conditions, and a business can lose the ability to operate not because it's unprofitable, but because it can't manage the timing of its cash flows. So, careful forecasting and proactive collection practices are the practical responses to this risk. So, we're going to go back to systems and consistency because, again, you could find that in the multiple choice questions. You could find it, these ones that seem to be repeating themselves are giving you a way of managing your answers in the short answer questions. Quality consistency isn't an accident. It's the product of well designed systems. When a customer experience, say, for example, when someone walks into a McDonald's for argument's sake, they experience a business that delivers the same quality reliably every time. What happens is the customer develops trust. They know what to expect. That trust is the foundation of retention and, more importantly, referral. When quality varies depending on who's working, what day it is, or how busy the operation is, that trust eventually erodes. Sarah's service, like Sarah's service quality issues, are probably a direct consequence of her reliance on an informal and, more importantly, an undocumented process. Without standard procedures, each employee is essentially inventing their own approach. And the result is inconsistency. The E-Myth framework positions systems not as a constraint on creativity, but as the mechanism through which quality is protected and growth then becomes possible. So, as you review Sarah's quality related scenarios in the short answers, systems thinking should be one of the lenses that you apply. Okay. Now, again, you're probably going to see these next few slides for a second time, but in different ways because this is the short answer. So, when we're talking about financing and risk, different sources of financing carry different risk profiles. And selecting the appropriate financing structure is the fundamental strategic decision. Debt financing increases financial pressure through mandatory repayment schedules, much like what I was talking about, a bank loan. Regardless of how your revenue changes, you still have to pay that loan. If Sarah's revenue, for example, fluctuates seasonally or her business is in an earlier unpredictable growth phase, debt can become difficult to service in time. Equity financing reduces the repayment pressure, but it dilutes the ownership and it may introduce outside stakeholders who have other expectations of how that business is managed. The owner loses autonomy. The critical principle for the exam is that financing decisions should be aligned with current stage and stability of the business. A mismatch between financing structures and the business reality is a source of significant risk. When you see Sarah facing financial pressure, consider whether her financing choices were appropriate to her circumstances at the time those decisions were made. Was it necessary to bring in, for argument's sake, perhaps equity financing versus taking out a bank loan? The market share and forecasting we're revisiting as well. And the this area is where I saw a lot of you do this in your assignments, where entrepreneurs overestimate their potential market share um, based on a variety of different things, such as commitments, financial and operational, where the business can't support them. So you're overestimating what your potential is without your business being able to support it. So Sarah's forecasting errors tend to follow the predictable pattern. She identifies a large market and assumes she can capture a meaningful portion of it without fully accounting for the competition already serving in that marketplace. Or worse, under underestimating the competition's strength that they have in their market. Oftentimes, an entrepreneur will come in and say, well, company B has a large market share, but my product is so good. My unique selling proposition is this, that we're going to take a large portion of that without accounting for loyalty from customers, for example. So, realistic forecasting requires an analysis of total available demand, the number and strength of competitors, and a credible basis for the share estimate. Poor forecasting is going to lead to an overinvestment, for example, in capacity or in inventory, staffing, that the actual sales volume isn't going to be able to justify. The downstream consequences of that overinvestment includes financial strain and operational efficiency, and they're directly traceable to the forecasting failure that preceded them. don't get stuck on Sarah's success now when it wasn't something that was sustained over a period of time. It could be a spike, it could be seasonal, such as Christmas time or whatever the case is. And eventually you might find that the sales end up going back to normal, normalization of the sales or revenue stream. So when we're talking about marketing and operations, let's talk about the relationship because the relationship between marketing and operations is the key cross functional dynamic in this course. Marketing exists to attract customers and generate demand. Operations exists to fulfill promises that marketing makes. So when those two functions aren't coordinated, the business experiences a specific and very damaging failure pattern. It attracts more customers than it can serve well, delivers poor experience, and suffers reputationally as a result. This cycle can be worse than not marketing at all, for example, because it actively damages the relationship with customers who have had high expectations. Sarah's growth challenges, um, her growth challenges are frequently rooted in this misalignment. She invests in marketing without first ensuring that her operational systems, staffing levels, and quality controls can support this new volume that marketing is designed to generate. Now, succession planning is the process of preparing a business to continue functioning effectively once that leadership changes. For a small business like Sarah's, the most critical succession question is what happens if she steps back, becomes incapacitated, or decides to sell? A business that depends entirely on its founder has limited transferable value. There's no system to hand over, no documented processes to follow, and no leadership infrastructure for the successor to step into. Succession planning is therefore not a personal consideration, it's a business value consideration. Businesses that have invested in leadership development, documented systems, and operational independence from their founders are worth far more and are more resilient. Sarah's failure to plan for succession is consistent with the broader pattern of short term thinking that characterizes many of the challenges that Sarah faces. So, I do want to move into the essay scenarios. The expectations for the essay section of the exam is where you have the greatest opportunity to demonstrate the full range of what you've learned. A strong essay is going to do several things. It's going to integrate multiple business functions, showing how decisions in one area affect outcomes in another. It'll demonstrate cause and effect reasoning, meaning that you're not simply describing what happened, but explaining why it happened and what the consequences were. It'll offer strategic recommendations that are grounded in the course frameworks, not common sense alone. Be careful with that. You need to ground everything you're doing in the course frameworks. And it's obviously it's going to be clearly structured with logical flow that makes it easy for the reader to follow your argument. Length alone does not produce a strong essay. Depth, integration, and clarity of reason are what matter. So, how to succeed? This is my last slide. As we're closing out here, I want to offer a few final thoughts on how to approach the exam itself. First, always explain why problems occur. Don't settle for describing what's happening. Get to the root cause. Second, use the concepts and frameworks from the course to deliberately and clearly explain your point. Naming a concept is not enough. Apply it to the scenario in front of you. Third, think across your functions. Very few of Sarah's problems exist in a single area of her business. The best answers recognize how marketing decisions affect operations, how operational failures affect customer retention, how financing choices affect everything else. Finally, demonstrate depth and clarity. Write and complete thoughts. As I was mentioning, please no bullets, but be precise. Prioritize the quality of your reasoning over the quantity of your words. I am not one to count pages. I one to look at the quality of your reasoning. So if you do these things consistently across all three sections of the exam, you're going to be in an excellent position. So this is where I'm going to wrap up the video. I've gone through all three sections. I've given you, I feel, a lot of opportunities on where to focus and a good strategy going into the exam. I'm going to see you on Tuesday, April 14th, and that's at 1 until 4. So good luck to all of you. And I'm looking forward to seeing what you've got on the exam as a demonstration of your learning. Thanks for a great semester, and I will see you on Tuesday.